Welcome to the NFT Finance Podcast, sponsored by Goldman Sachs. My name is Terry, and I'm joined by my co-host Thomas. And today we welcome Joe from NFTperp, an NFT Perpetual exchange.
Hey Joe, how's it going?
Here. Good.
Yeah,
Thanks for having me.
Yeah, man, glad to have you on. So let's just jump into it. Let's maybe do a quick background on yourself, how you got into crypto, NFTs, and then we'll jump into, what is NFTperp?
Yeah, totally. So I worked for a private equity firm before I got into crypto, and that was in 2016. In 2017, a buddy of mine started an ICO, and I helped him out a little bit on marketing operation side of things. And eventually it becomes like, oh, this Bitcoin thing is quite interesting. So I read the Bitcoin white paper. The next day, I put half of my savings in crypto in Bitcoin. And 2 weeks later, I found out about Ethereum, read the white paper, and I sold everything that I have in Bitcoin to change it into Ethereum. That was my first introduction into crypto. And then later on, I worked for a venture firm, based in Asia, focused on early stage boutique venture firm that eventually focused on high frequency trading. And that was like my first, introduction into crypto. I worked at the firm for about a year and a half, and eventually left, do my own thing for a while, was focusing on product management for a lot of Web2 companies that focused on e-com, SaaS products, affiliate marketing. So I work with dev teams, lead them to optimize for better conversion rate, high revenue, better UI UX. So I have a good, pulse on working with dev teams, and also, financial instruments from my experience in working with firms. And then later on, in 2021, I worked on a DeFi protocol, like a liquidity aggregator, took some outside capital, launched a token, didn't find PMF. It was a bit of a failure, but learned a lot from that experience, and somehow found my way into a NFT investment DAO called Sweeper DAO. We collectively swept floors on NFTs, put money together, and we had some blue chips as well. And the issue that we kind of ran into was like we didn't have properly take profit strategies. Like there weren't any hedging solutions out there available. So came across this article by Dave White from Paradigm about four perps. It's like, oh, this is quite interesting. This solves my problem. So decided to really dug into the tech side of things and see how I can bring this to life. I met my co-founder beginning of this year. He worked for Citigroup, RBC, Leontech as an exotic options trader. And we kind of came together, and he focused on protocol design. I focused on all the business and product side of things. And we started working on NFTperp, and we pushed out our MVP at the end of March. In the beginning, we actually launched our MVP on Polygon, but ran into a lot of RPC issues. So eventually shifted over to Arbitrum, and it's been a really good experience building ever since. So that's a little bit about myself.
Normally, I'd ask you directly about the protocol, but I do have to ask, what gave you so much conviction after reading the Bitcoin and Ethereum white paper to essentially like eight-ball half of your life savings into it?
So my dad was a real estate. My dad was in real estate for quite a while, in his early 20s and 30s, and got into. I'm from Taiwan originally, and we have a lot of semiconductor trades and whatnot. And he got hit pretty hard when the financial crisis came in 2008. We, as a family, I think, I wouldn't say we were well off, but we were comfortable. And when 2008 came, I think I was, what was my age? I was probably 12, 14. I can't remember what my age was, but we went from, living in a nice house to my dad was driving this BMW car, was, living life pretty well. And to him was driving this 20-year-old Volkswagen T4 in a matter of a week. And I was told by my parents that we're broke, don't have any money anymore, and we'll have to move up to the suburbs instead of being in Taipei City because we can't afford rent. So, like it hit me pretty hard. And as a kid, it doesn't really resonate with you. Like you just kind of do whatever your parents tell you to do. And eventually, that kind of just, is in the back of your head. And as a kid, you just think about like ways to make it coming out of, I wouldn't say poverty, but, like as a kid, you understand what your family situation is and you try to make the best of it growing up. So when I read about Bitcoin, I think and I had a decent understanding at the time of what happened in 2008. And I just had a strong conviction of what this was. And I didn't know how big it could be, but it just made a lot of sense for me in terms of the power of decentralization. And I wouldn't say I'm a libertarian, but I definitely have, different values that align with those group of people when it comes to monetary and power and governments. So that's why I put, half of my saving, which at the time wasn't that much, to be honest, it was a couple $1,000 into Bitcoin. And Ethereum obviously had a different application level of understanding for me that I felt like this has a larger standing ground of what could be built on top of it. That gave me strong conviction towards blockchain in general.
Gotcha. Yeah, let's get into the protocol. What is NFTperp?
All right. So NFTperp at its core, it's a DeFi protocol that solves the problem of people not being able to short NFTs on the spot market. I personally think having to deal with illiquidity, the illiquid nature of NFTs makes it extremely hard to do lending and borrowing in the form of margin trading and shorting on spot. So you have to do it on perps. So we kind of saw the Lego pieces around DeFi and put together a protocol that are catered towards NFTs specifically. So it's an on-chain perpetual futures exchange that don't hold custody of your assets and allow people to go long and short on the prices of NFTs with 5x leverage for the sake of capital efficiency, not for you to get wrecked.
Gotcha. And can you give us an Alice and Bob example of, say, an LP and a user or a trader on NFTperp and how they would interact with the protocol?
Yeah, for sure. So we adopted the Perpetual protocol virtual MM model and made significant modifications on top of it. The basic trade scenario, like an Alice and Bob, would kind of look like this. Like in the initial state of a quote unquote virtual MM pool is the operator of the protocol, like us, setting a arbitrary number inside the virtual MM. That kind of looks like Uniswap V2 pool, where you have an X and Y asset, and that equates the K value that represented the depth of the liquidity pool. So let's say you have 10 BAYC, virtual BAYC in this virtual pool, and then 1,000 Ethereum. That gives you the price of BAYC being 100 ETH. Now, at this point, there's no traders in the protocol at all. There is a liquidity backstopping pool called insurance fund back in this pool. So let's say there's 20 ETH in there in the insurance fund. Now, Alice wants to go long on BAYC. She would deposit 1 ETH in the clearinghouse as margin. Let's say she wants to apply the 5x leverage on the trade. That will have a notional value of 5 ETH buying power into the pool. So let's say she puts in this 5 ETH into the pool. She would take out, in this case, 0.04975 BAYC from the pool, representing her position in this open position account. So she's not actually technically withdrawing any tokens from the virtual pool. It's just the open position representing her position. Now, Bob comes in, say, taking another long position with 1 ETH as collateral and also 5x leverage long. You will have a slippage incur, and the Bob position of 5 ETH in the pool would equate to a little bit less than 0.049 BAYC as opposed to Alice's, because the price entry is different. And by this point, Alice, after she entered the pool, the price of BAYC will be at 101, moving the price up by 1% because of liquidity depth in this case is thinner. Bob will push it up to 1.2. So Alice will have an unrealized profit of 4.988%, so like 5% increase, even though the price only moved up 1%, right? But because she has a 5x leverage. So Alice can now close the position by putting back the virtual BAYC that she, supposedly bought from the virtual pool back into the pool and essentially take away more ETH than she put in the beginning. So in this case, it would be a withdrawal of 1.04975 ETH. So she's profiting a 1% movement of 0.049 ETH in that position. And Bob will have an unrealized loss until he closes the position, puts back the BAYC, and got less ETH than he got in the beginning. So like a zero-sum game, basically.
Gotcha. Yeah, that's a great explanation of the model. But I guess there are also listeners who are familiar with, some of the limitations of the model and how it's been applied before. I'm quite curious to hear what your take on what those specific limitations are. And then you mentioned that you had some modifications to the core protocol to make it work. Like what are those and how do they work?
Yeah, good question. So the basic problem that Perpetual protocol ran into in its V1 model is you have this BAYC, or in their case, let's take ETH as an example. So let's say in 2020, October, Perpetual protocol launched their ETH market pair, and the price of ETH at the time is, let's say, at $500. At the peak of the bull market, the price of ETH was at 4,500 or something. Now, all the longs that have pushed the price up from 500 all the way up to 4,500. Now, not I'm saying that they're all the same people or same users, but the same amount of open interest need to maintain open in order for the price to stay there. And if everyone settles and everyone exit that market pair, the price of ETH will go back to 500 in their case. So that creates multiple different problems in the protocol. Number one is obviously you have to have open interest maintaining long for that to price stay there. And number two, it creates a pretty big imbalances of longs and shorts in the system in the form of open interest. And when you have a fixed funding rates on perps, and for those that maybe aren't familiar with perps, funding rates are the delta in between index price and oracle price multiplied by your notional value on a trade. Periodically, you get charged or pay that position. So when you have longs and shorts imbalances that are in a massive skew, you're going to run into a protocol cost of funding fees that the insurance fund is actually paying out for those that are owed. So what I mean by that is if you have a bunch of long positions and the funding is negative, meaning the shorts need to pay the longs, and there's not enough shorts on the side to cover the longs, the protocol actually pay out in those instances for Perpetual protocol version 1. So the fees that they were generating from market pairs in terms of protocol revenue is less than the cost that they're paying to maintain a market pair. And that over time ran into insolvency problems. So that's sort of the limitations, the core limitations for a VMM model, right? That's the case for another exchange called Drift Protocol on Solana. They also ran into, and their iteration of solving this was they essentially cap the funding to be 50%, so the protocol doesn't bleed out so much. So our iteration is quite interesting as well, and so far it's been playing out well in our testnet, and we'd love to see how it plays out on real money markets. But the basic idea is you take longs and short ratio into account, and you essentially let the funding rates to be baked in, factoring in the long and short ratio. So what I mean by that is if you have more longs and shorts in a imbalanced market, you allow, let's say there's more longs and shorts. And in this case, the funding is negative, the long need to be paid. You essentially let the long to collectively receive less funding and you increase the short side funding by just a little bit, and you balance out both sides, so it will be net zero for the insurance fund to pay anything. That's called dynamic funding Vs we've implemented. And that's sort of one of the iterations we made on top of Perpetual protocol. Outside of that, we have this dynamic liquidity adjustment. And what I mean by that is going back to what I was saying earlier about the operator setting a virtual liquidity depth, which is arbitrary number. The K value at its core for Perpetual protocol, when they first launched it, is that it's fixed. So effectively, before they even launch the market, they will need to factor in all the market uptrend, downtrend, open interest, volume, everything. And that number is set and immutable. We find that troubling. And for us, we kind of see it as a K value that needs to be adjusted over time based on open interest, because you can't predict what's going to happen in your market. So if you see more open interests, slippage gets really high when there's a lot of volume coming in, you need to be able to dynamically adjust that K to scale up in the form of multipliers, or scale down in the form of multipliers without changing the price, so that you can withstand more open interest and volume over time. So that's number one in terms of dynamic virtual liquidity adjustment. With the K value, that tells you open interest allowance. It tells you the liquidity depth of the protocol, so it can withstand different volume of trades. Now, there's another thing called a convergence event that we apply on top of this virtual liquidity adjustment, and that is over time we should be able to adjust the quote asset, which is the X and Y value, the Y value inside the virtual pool, so that when the price settles over time, everyone leaves the market, you can still have the price of that specific asset maintaining at that high level, as opposed to going back to the initiation price of the protocol. It's a mouthful. I'm not sure if you're following me, but that's kind of how it works.
Yeah, I think that makes a lot of sense. I guess, like from an outsider's perspective, for the listeners who might not be too familiar with it, what were the blockers that held previous iterations of similar perpetual protocols of having a dynamic fee adjustment?
I think the main thing was the cost of the adjustments if they weren't able to effectively upgrade your contracts. So we've learned a lot from our previous ancestors of the protocol, being Perpetual protocol and Drift protocol. The cost of repeg could be high, like convergence events could be high if it's not calculated correctly. So for us, we have to bake in the contraction and expansion of K value, because it does come at a cost of traders either being in profit or losses. And I think for us, as long as that's communicated with traders and knowing like, hey, from time to time, there will be a convergence event and it comes at a cost of either the protocol ends or your ends, and you need to be okay with it. That's how the protocol need to operate in the long run and be sustainable. So that's number one. Number two, there are essentially no LPs in both the case of Perpetual protocol version 1 and also Drift protocol version 1. And this is where it gets interesting. We kind of think of this model as the GMX model, where you have GLPs coming in, essentially be the counterparties for traders. GMX model is market dependent, right? It's dependent on Oracle pricing for a specific market pair, as opposed to a independent discovery of price in that exchange. So ours is independent, right? You have our own price discovery mechanism, and periodically you check in with the Oracle price to charge a funding, to pay a funding. But in our case, like, we think if you add another layer of LPs on top of all this to give them trading fee incentives, liquidation incentives, in exchange for them backstopping that debt in the system, it makes the system more robust. And that's why we've been saying that we're, in a way, indirectly, kind of like the GMX for NFTs.
Gotcha. That makes a lot of sense. One thing I'm curious about is there are currently a lot of users who are, at my understanding, paper trading on the protocol on testnet. I'm curious, who are the teams on the leaderboard who are using the protocol, and sort of like Have you noticed a bias on the short side or the long side or anything like that?
Yeah, good question. So we launched a trading competition because we thought that there's a knowledge gap in between the DeFi community and the NFT community. And for us to literally expand the Venn diagram of the two, like a lot of practice trading need to be involved. So it's the way we see it. So trading competition is a way for us paper trading competition is a way for us to train user behavior, introduce the idea of perps on NFTs for traders and knowing how funding works and whatnot. So for us, it's one, user acquisition, and two, training user behavior so they can adapt to it once we actually launch a protocol with real money when it go live. So the teams are basically, whenever they sign up for the trading competition and they claim the mock WETH that we deployed, they also get airdropped a token that's a soulbound token, fungible token, but soulbound. And these are two types of tokens. It's either a peanut or it's an almond. And when you get randomly assigned one, and when you get assigned it, you also see it on the leaderboard dashboard as a trader, which team you're assigned to. And what we're doing basically is throughout the trading competition, we have currently, I think we have 1,400 traders that are actively trading. If you rank top 200 on the leaderboard based on your realized profit and losses, you get our future tokens that we'll launch when we go live with our token. And if you are on the winning team, so combined with all the almonds and the peanuts, they get aggregated P&L together. If you're on the winning side, you get 1.5x your tokens if you're ranked on top of 200. If you're on the losing team while being on the top 200, your token incentives gets a 0.5 multiplier. So like a decrease basically. And that's how we essentially create a game within the game. And that's been a really fun way for our communities to get engaged. And it's just also just, good for the shits. People are calling each other nuts, peanuts, almonds, and, telling these nuts jokes. So it's just our way to, keep things fun while having a new financial primitives in the space.
I have to say that's both extremely interesting, but also very brutal as well. But yeah, I guess along with that, I'm very curious who is participating. Like, what type of users and user personas are actually participating in this trading competition, and also, have you seen a skew towards the short side? Because I guess you can always long spot, but one of the pain points that you are addressing is you can't really short.
Mm-hmm. Yeah, I think because of the NFT marketplaces and the entire space has been operating without a quick exposure hedging, shorting solution for the past 3-4 years, or maybe if you really argue it's 2 years, we're naturally going to see a lot more shorts than longs. And that's the way it's been played out since we launched the protocol. And that's pretty fair, right? Like the price has been down since we launched it across marketplaces and different collections. So naturally we see more shorts. And what that means is, typically speaking, you will see the fundings being negative on our protocol. So essentially the longs can come in and get actually good yield on the funding rates if they are on the right side of the trade. So definitely see more shorts across the board. In terms of the traders that are coming in, like for now, we're seeing a lot of DeFi protocols users that are familiar with perps, but also a good amount of NFT collectors and traders we've seen. For us, one thing that we've been focusing on is speaking with NFT communities, and with that we partnered with Hootlist from Moonbirds. We partnered with GMDAO, which has a lot of NFT communities in there. On the Degen and DeFi trading side, we're partnered with Degen Score. So they have this very interesting soulbound token initiative that they're launching on, I think in 3 days, on the 17th of November. That essentially, if you have 700 and above on Degen Score, you get to mint this beacon soulbound NFT that follows you everywhere you go, like a Web3 community, Web3 credential pass kind of thing. So we partnered with them to bring on a good cohort of users. We also been working with Nansen to bring on users. So a good amount of DeFi users and a mixture of NFT collectors, holders, and traders in general. And we've been going quite aggressively on user acquisition, getting quality testers on the protocol, and while doing surveys so that we know what type of open interest we can expect, what kind of market pair we can expect, so that when we do go live, we can be realistic about what we list and how much open interest we allow.
How does the floor price oracle work? Like how is it in back tests that you guys have done? What has been the cost of manipulation? How centralized is it, and what's the plan in terms of migrating this oracle into something else in the future?
Yeah, great question. So our price oracle don't take floor listing values into account. If you look at OpenSea, LooksRare, whatever marketplace you're on, typically there is a floor price that's represented by the lowest ask on the order book. So we don't use the listing values for our oracle. What we do instead is we look at one specific collection that's traded on multiple different marketplaces, and let's say BOYC as an example, right? It's traded on OpenSea, LooksRare, X2Y2. I don't think it's on Pseudo right now, but it's on Blur as well. So what we do is we literally look at all the historical sales within the collection, and we identify the mean value out of these and remove the extreme outliers from the sales. So these sales could be far too expensive, far too cheap. And then from there, you get cleaner set of data. And you identify with a standard deviation between a set of samples, and you can create this upper bound and lower bound of a price range. We would call it acceptable price range, so that all the sales that are coming in the future via the API calls and on-chain listening of events will be checked back with this acceptable price range. If it's within, we'll continue to calculate it. If it's without, it will be essentially excluded. So someone can't go like buy up the price which would dump it by 50% and consider that to be included in our oracle. It had to be close to floor by unique buyers and sellers in our data eligibility screening events. So that's overall how the price oracle works. And we also have a TWAP for all of this. So to prevent the event of spiking. If you spike on one specific exchange, in terms of buying a ton of different inventory, the other marketplaces will have to also be arbed in and be calculated with our oracle. So that's kind of how overview of how the oracle works in general. It's centralized. The calculation is off chain, and we bring it on chain with the Chainlink infrastructure. So we have a node with Chainlink. We are an operator of a node, and we are also the consumer of a node with our contracts.
I often ask this to a lot of the guests that come on the show, but one thing that is somewhat holding back, NFT finance and its broad adoption is, the spot liquidity, right? Like, if you have 10,000 items in a collection, it's quite difficult to have, say, like 3,000 trading on spot and then 3,000 locked in NFTfi, and then again, like derivative volume higher than notional trading spot volume, because then the cost of manipulation versus the benefits and what you can get out of manipulation, say for an oracle, it can a little bit skew the market there. So it seems like a lot of the times, NFT finance projects have a natural limitation. I guess, like, how are you thinking about this? How are you thinking about expanding the market?
That's a really good question. So for us, I think we can't operate with a mindset of rainbows and sunshine. Once you move things on derivatives, you still have to be mindful where spot liquidity is in terms of liquidity depth. And adjust your open interest and liquidity depth on our protocol accordingly. And for us, it's just more about recognizing that and set the parameters the right way, so we protect users first and foremost, and then outside of that, you kind of have to let the market play out over time in terms of what market pair is driving volume, what market pair is adaptable, long term for perps. I think there's more things you can build on top of it. Like I keep coming back to the idea of structured products for NFTs. I'm incredibly bullish on protocols like Putty. Right now, physically settled is obviously like limited, but if you can move towards cash settled with a robust Oracle system combined with perps, you can build more things on top of it, and in a way, you can have the perps to be more, or derivative side of things to be more liquid compared to spot over time. But for now, I think it's incredibly limited on spot because of how illiquid it is. But at the same time, I also am optimistic about perps being able to have an impact on spot liquidity over time. And I've been preaching this for a long time. I think one of the reasons why NFT spot liquidity is so bad is because of the cost of market making is quite high. So if you're market making on a centralized marketplace, typically speaking, you're getting charged twice on bids and asks as a market maker, on platform fees, on royalties. So because of that, the spreads are kept really, really wide. And that's one reason. And number two, there's no way to offset your inventory risks as a market maker doing NFTs. So in my mind, when there is a platform that allows you to have much tighter spread as a market maker without getting charged twice on fees, and if you have a built-in system that allows market makers to offset inventory risks, all of a sudden you can have a much tighter spread on spot market because market makers are able to, hedge your inventory risk on perps. So for me, I think these things take time, but as you move forward with different market making firms and people that understands how liquidity works in NFTs and can offer offer value of what they're doing over time, I think it translates back to what we're doing on perps as well. When market making is more sufficient and efficient on spot.
Gotcha. That makes a lot of sense. What's next on the roadmap for NFTperp, and how can people get involved if they're interested?
Yeah. So we're hoping to launch our private beta on the 17th of November. But with the FTX situation, I think everyone's attention is drawn towards that. So we decided to pause and postpone that. Part of me think it's not a great time to launch a protocol. And two, I also think it's a little bit tone deaf to be launching JPEG perps with leverage, when a lot of people are suffering. So in my mind, we're launching the current tentative date for our private beta, which is with real money for invite-only users, will be on the 24th of November. So in 10 days. I don't know when this podcast is coming out, but maybe by the time you're listening to this, it's already out. So we're working on this private beta for invited-only users for at least, in my mind, at least 4 weeks, but probably will end up being 8 weeks long of real money perps. We've been running this on testnet for the past 5-6 months. It's been stable. There's no major issues. We've been continuing reiterating our front end, our UX UI. People have been liking it. So we're excited to push this out with real money and have one of those, actually scalable perps for NFTs in the market. So if the listeners want to find out more about it, you can join the paper trading competition right now if you like, but you can also wait for the private beta. Come to our Discord. You can apply for a private beta application, and we'll whitelist your address, and we can start playing with it. But that's sort of the short term of things that's going on with NFTperp. Long term, there's a lot of things we're pretty bullish about. We're wanting to make our protocol more composable over time. So whether that means the collateral need to be composable or the positions can be composable so that more things can be built on top of it, are the things that we spend a lot of time on researching and developing, so we can build across the board more composability with other protocols that we're friends with at NFTperp, so we can kind of build a moat around the protocol.
Awesome. Thank you, Joe, for your time today. And listeners, go check out NFTperp and sign up for their trading program.
Thanks, Terry. Appreciate your time.
Follow me on Twitter. I'm 0xTayTayHoHo on Twitter. That's Tay with an E. And you can follow Ryan at _Helmass.
Yeah, and that's _HELMASS. Thanks everyone for tuning in, and we'll catch you soon.